Hello. Today in less than 5 minutes, K&G International Advisors will give you a summary of last week's most important international financial news, focusing on Goldilocks and the three bear markets. Last week, we claimed that this year represents a rare moment in financial markets, which typically only occurs once every decade or so. A year where the financial paradigm changes, where the old rules and investment strategies that worked stopped working, and where new approaches will be needed for success in investing. 2008, 2001, 1987, and 1984 are relatively recent examples of these. These periods of change in financial markets are almost always accompanied by a bear market of stocks. A bear market is a market which trends down for a prolonged period, typically between 3 months and as long as 2 years in some cases. And there are different types of bear markets too. 3 in fact. If we are right and 2022 turns out to be as important as previous moments of market dynamic shifts like 2008 and 2001, understanding what type of bear market we're in is critical to determining how investors should be positioning themselves. It also helps us estimate how long the bear market will last and when we can start thinking about the next bull market. We think of the 3 bear market categories as being structural, event-based, and periodic. A structural bear market is one driven by a major structural readjustment in the economy. The 2008 bear market was structural, as it was driven by a global collapse in the confidence in the banking system following the bankruptcy of the Lehman Brothers. The 1929 crash and subsequent depression is another example. Structural bear markets are typically very long in duration, often lasting many years. Unsurprising given the structural causes, as these negative factors take a long time to wash out of the system. Event-based bear markets, the second type, are very different. These are the shortest in duration and are caused by a specific and usually unforeseen event. The 2020 bear market is a classic event-based bear market, triggered by the COVID-19 pandemic. A highly uncertain and sudden event changes the market sentiment and asset prices decline quickly in response. Since these are not driven by major structural problems in the economy, these bear markets often resolve themselves quickly, as was the case in 2020, with the market rally a strong bull market in the April to December 2022 period. The third bear market category is periodic, or cyclical. These are bear markets triggered by the late stages of a business cycle and the subsequent rise in interest rates that come in the late stages of a bull market. Typically, inflation is rising, central banks are rising interest rates, growth is slowing, and a bear market in assessed prices occurs. Does this sound familiar? It should do, and this is the category of bear market we believe we are currently in. What does this mean for investors? Periodic bear markets typically last between 9 and 18 months. And they are not accompanied by major financial crisis, so the rally out of these markets is often quite strong, usually in more value-oriented stocks early on, followed by growth stocks later in the rally. The 2001 to 2002 bear market is a classic example of this. The recession then was mild. There was a bear market followed by a 7-year bull market in stocks. If you're right, we're currently 6 to 9 months into this bear market. The bad news is that there's going to be a bit more pain in the markets before we can start thinking about a sustained recovery in asset prices. The good news is that, well, we're already 9 to 6 months into this thing, and that means, based on historical examples at least, that we're probably less than 9 months away from the end of this bear market. Before the 2020 pandemic, the 2011 till 2019 economy, an accompanying bull market, was often described as a Goldilocks economy, one where inflation and growth were neither too hot nor too cold, but just right to sustain asset prices, appreciation, and a strong economy. Investors should not count on the possibility of a return to this Goldilocks economy after the current market situation. The factors that have given us such an economy before the pandemic are still there under the surface. Though we're not predicting this particular outcome, investors should not count on the possibility of a return to this Goldilocks economy after the current market situation. The sources used on today's video were Yahoo Finance, Bloomberg, and Dominion. My name is Juliana Lato from K&G International Advisors. Don't forget to subscribe to stay updated on all the important financial news. And don't hesitate to contact us if you have any queries or further comments.